Good, good evening. I don't even know whether to call it evening or morning, but it's 2:50 a.m. on the spot. Friday, 31st October 2025, and doing this recording at this time to make up for the lost time on Friday. Sorry, Wednesday, because of the injury I had, the accident I had. And guys, there's no there's no a car accident for those who cared to ask. It's just a minor accident on my thumb. And what actually happened was, what I thought happened was a dislocation. But when I went to the hospital to find out, told me it was a sprain. So I tore a tissue in my thumb because I decided to be reckless. I'm not going to go into the details of it, but my thumb is okay now. I can do this. Can't go all the way down, but I can do this now. And I can do this. But yeah, it's healing. Yesterday was painful, but it's healing. The swelling is going down. And I'll be fine in no time. So I'm doing this recording to make up for the time, and I'll go straight into it. Okay. Introduction to Forex Trading. um Forex trading is the world's sorry Forex is the world's largest financial market, and it trades up to $7.5 trillion per trading day. Each trading day, the Forex market trades $7.5 trillion. The percentages vary in terms of the actual participants in the Forex markets, that sum it all up to $7.5 trillion. They vary. Some are retail traders, some are banks, some are um, big institutions, hedge funds. But the whole point of it is that they all participate to make this 7.5 or $6 trillion possible each day. 7 point. So as you are sleeping now, money is flying through the Forex market, and then people are earning money as you are even sleeping. Maybe I'm not a betrayer, I'm not earning, I'm educating. So right now I'm educating, right now I'm not earning. So I'm not on the charts trying to find anything. I'm just educating. So let's go straight into it. What is Forex? Now, Forex is a global OTC market. What I mean by OTC is it's an over the counter market. That means you can access it anywhere, anytime. Once you have a phone or a laptop, let me just say, once you have a device that can connect to the internet, you can access the Forex market, and it's over the counter. Over the counter means you don't have to go to a specific location to access the market. You can have it on your phone, you can trade it on your laptop, you can trade it in your office computer, whatever. That's what we mean by an over the counter market. So the Forex means foreign exchange. That's the whole point of the word Forex, foreign exchange. FOR for Forex, EX for exchange. And guys, please, my hair is very messy, that's why I've covered it. It's very, very, I would rather I wear this than show what my hair looks like. So Forex is the global financial market for trading currencies operating over the counter. Sorry, for trading currencies operating over the counter. So it's the global financial market for trading currencies in the sense that every currency that is traded in the world, or every currency that moves through the Forex market, sorry, every transaction concerning any currency in this world goes through the forex market. Now let me make that clear. For example, China wants to buy gold from Ghana. It has to change that. I don't know if Ghana accepts dollars, but let me make it very basic so that everybody can understand. If China wants to buy gold from Ghana, it has to change its currency to Ghanaian currency before buying that gold. Now, that transaction, right, is recorded, and I don't know the exact procedure it goes through before it's recorded in the forex market, but it's always recorded. Do you get it? So big companies who would want to make transactions in certain countries will tell their banks and say, okay, on the 30th of December, I would want to buy this amount of goods from Ghana, and this is the money I have, and I'm going to transfer it, or I'm going to change it into Ghanaian currency before I buy the goods. Now, that, how do I call it? That future transaction, right? That future transaction is what would be recorded in the market as a bullish run in the Ghanaian cedi, or when you are trying to monitor the Ghanaian cedi. So let's assume we've passed pace time and then it's December 30th. What's going to happen is that immediately the transaction is recorded and it's processed, right? There's going to be a spike in the Ghanaian cedi. Why? Because the Ghana has gained strength. The Ghanaian cedi has gained strength from the transactions that China did with Ghana. You get it? So more money has been added to the Ghanaian cedi, and then it has given it strength. So that's all I can say about. Charlie, please bear with me, okay? When you watch back, bear with me, I beg you. Now, profit mechanism. You profit if you correctly speculate that one currency will strengthen against another. Making money on the forex market is based on your speculation. Do you get it? People think forex market is an investment. People think the forex market is an investment, like the Bitcoin market. Like you buy the forex, or you buy the currency pair and put down and wait for years before you take it out. Now, that is an option in forex trading, but the most common one we do is speculation, immediate speculation, day trading, intraday trading, or sometimes swing trading, which takes about weeks or even a month to pan out. So yes, the common misconception that forex is an investment platform is arguable, because putting there and gaining money back can be termed as an investment, but what we call it in the forex world is speculation. You speculate and then you get your money. So let's assume you speculate that the Ghanaian cedi is going to gain strength against the Chinese yuan on 30th December. I'm making this up from the previous example I gave. So Ghanaian cedi is going to gain strength against the Chinese yuan on the 30th December. So what you do is you buy the Ghanaian cedi and then you wait for that transaction to be processed. And after the transaction is processed, it's going to push the Ghanaian cedi up in value, and you are going to get a money for speculating. You are going to get an amount for speculating correctly. That's the profit mechanism of the forex market. So profit over here is based on speculations. I mentioned earlier there's a there's a mode of trading or a type of trading that allows you to keep the money in the account as an investment. You put it down. That's swing trading, position trading, where you have to wait for long periods, weeks and months, sometimes even years for position trading before you take your money out. Then the market scale. The FX market trades a massive 7.6 trillion per day and is open 24 hours per day. Yes, so unlike the stock market, which has a closing time each day, the forex market is open 24 hours a day. However, it closes on Friday. Guys, please bear with me. I'll be doing this a lot because I have a bad cold. It closes on Friday and opens on Monday again. Or if you're in our part of the world, you see it open Sunday. The reason is there are other time zones that are ahead of Ghana's time, and Ghana does not regulate the forex market. Ghana's time does not regulate the forex market. Or Ghana is not a big player when it comes to the countries with authority. Do you understand? Like the Asian, some Asian countries like China. You see. But just so we are clear, the forex market does not open based on the countries that have strength when it comes to currency, but it's based on the country that is ahead. So most times, the Asian country opens the forex market because they are like 9 hours ahead of us, and then by the time we even think of entering Monday, they are already in Monday. So forex market would have to open based on their time. Why? Because they are way ahead of us. You get it? So just so we are clear, it's not like the forex market is not opening because your country doesn't have power or whatever. Understanding the exchange rate. The exchange rate is the price of one country's currency expressed in terms of another country's currency. It tells you how much of the quote currency is needed to buy a single unit of the base currency. The market is in constant flux due to the range of participants. Now, what the exchange rate is the exchange rate is the numbers you see attached to the quotation, the forex pair quotation. So mostly when you go to the forex bureau or when you open your MetaTrader app, you see a pair like USD GBP. USD GBP is equal to 1.109 something. Now, what that means is that to get 1 USD, you need 1.109 Great Britain pound. Do you get it? That's what is written over here. The exchange rate is the price of one country's currency expressed in terms of another country's currency. It tells you how much of the quote currency. So the quote here means that whenever they are quoting forex pairs, they do it in twos. The first is the base currency, the second is the quote currency. The base currency is what you are trading. So if you see a pair like USD JPY, you are mainly trading USD against the JPY, although you are simultaneously trading the JPY. But what you are mainly doing is you are trading the USD. Do you get it? So a forex quote is the quotation of two pairs, that's USD and JPY. Sorry, it tells you how much of the quote currency. So how much of the quote currency, that's the JPY, is needed to buy a single unit of the base currency. When you check USD JPY right now, it's I don't want to go off of this page, but it's a lot. You need a lot of you need a lot of JPY to get 1 USD. So it tells you how much of the quote currency is needed to buy a single unit of the base currency. That's the exchange rate. what is traded in Forex. What we mainly trade in Forex is money. Now, because Forex is a market for the exchange of currencies, saying money is safe, saying that money is what we trade in the Forex market is very, very safe. Why? Because currency is money. Do you get it? Money is the asset. You are trading one currency against another, essentially buying a share in a country's economic condition. So what you do when you trade the Forex is, for example, I wake up tomorrow, then I say I'm going to trade the um USD JPY. I'm going to trade the USD JPY pair, and no, let me use GBP. I'm going to trade the GBP JPY. Again, pardon me. I don't want to be pausing and I don't want to do all of that. A friend was telling me sometimes you have to, you have to pause, go and do what you have to do and come back. And I'm like, oh, it's too long for me. I'm not trying to, do some fancy work. I'm just trying to put educational content out there. And I'm a human being like everybody. I fall sick or I go ill. Charlie, whatever, Charlie. Let's focus. So you are trading one currency pair against another, essentially buying a share in the country's economic conditions. So when I'm trading GBP JPY, then I buy GBP JPY. What I mean by that is I believe in the economic power or the economic condition of Great Britain. That's why I'm buying Great Britain against the dollar. Do you understand? I believe there are projects going on in Great Britain that is going to boost the currency, the GBP currency. So it is going to be good for the currency strength. That's why I'll buy it. Do you understand? So I essentially buying a share in a country's economic condition. I'm buying a share in the country's economic condition. If I buy GBP JPY from whatever level and then I go up 100 pips, that means I've gone up 100 pips in profit. Do you get it? I've stake on the economic condition of Great Britain and then I've profited from it. You get so like you're buying a share in the country's economic condition and then you exit at when you want to exit. You get it? Yes. Economic reflection. The currency price is a direct reflection of the country's economy compared to others. A very clear example of what I just read is Ghana and then US. So the price of Ghana's currency is a direct reflection of that country's economy compared to others. So if you are trading a pair like USD GHS, that's US dollar and Ghana cedis, you are going to realize that the Ghana cedi will be weaker against the dollar, although it's gaining momentum currently, but then it's still weak against the dollar. So the price of Ghana's currency is a reflection of what is going on in Ghana. What's the price of Ghana's currency now means that there's nothing major going on in Ghana that gives so much value to the cedi. Do you understand? Most of the things that we do, we don't export them, and then we don't produce things that have demand for the outside world. Do you understand? And then even the things that we produce out of demand to the outside world, they already have their plugs. They're already getting it from other countries. So why should they come for ours? Do you understand? Yes. So we don't have enough exports than imports. Do you understand? And this is a fundamental imbalance to any country. If you are importing more than you are exporting, your country's currency is going to be weak, and that is a direct explanation of what's going on in Ghana. Do you understand? So the country's price is a direct, guys. Sorry if you hear this. I don't even know the way to call it, but you hear this, yeah, sneezing and sniffing in the audio. I beg, I'm very sorry. The currency price is a direct reflection of the country's economy compared to others. To those who stake everything they have on technical analysis, please, you are going to need fundamental analysis. Fundamental analysis, because fundamental analysis tells you what is going on in the country. Do you understand? So, um, an example is Mahama recently went to I don't know the exact state. I wanted to mention the exact state, but he recently went to, sorry, His Excellency the President John Dramani Mahama went to US, and then they published his picture on some board in the Times Square. Understand? That alone, right? That alone, if you had the hint that Mahama is going to America to do something like this, right, you could have bought the Ghanaian cedi. Why? Because investors react quick to these things, except for Ghanaian cedi. Actually, if it was a country like China, you see that their currency is fluctuating, shaking, you can make big profits, but Ghanaian cedi is mostly unheard of. So if you had the insider information on a move like this, you know the president is going to go here at this time, and they are going to publish Ghana on the Times Square screen, and right over there that Ghana is open for investment, right? Investors react quickly to this. When they see that Ghana is open for investment written over there, immediately they start making their moves. Do you understand? So that's fundamental analysis. So if you think starting and trading is all about technical analysis, please think again. Fundamental is very important, not so much important to me. To me as a trader, not very important. I just need to see the times, and then the dates the economic events are going to be released, and then I'll just follow through. I don't need to be going and be calculating all these GDP and things. Charlie, it's stress for me. I didn't even pay attention when they were teaching GDP in school, because it's too foreign for me, but I realized I need it, so I went back to learn it. Currency classifications. Currency are categorized based on liquidity and trading volume. So um the reason why this is written there is currencies are classified into three. That's what I know of currently, and that's what the the resources I've gone through tells me. So we have the majors, the crosses, and then the exotics. The majors are the most frequently traded pairs, like the euro, the dollar, the pound, and then they are mostly, or they are always coupled with the dollar. So if you see a pair like USD, blah blah blah, GBP, no, USD CAD, USD AUD, USD CHF, USD GBP, USD JPY, USD EUR, they are all major pairs. They are always coupled with the dollar. Now the crosses are pairs that do not include the dollar. However, there's a cross like EURUSD. What we call that is, we call that a minor. It's most people don't know it, but we call it a minor, and I should have added it, but it still doesn't disqualify the fact that there are three main classifications of currency pairs. Understand? So that's why I didn't add it. The crosses do not include the dollar. So when you see a cross like Euro USD, that means that's what we call a minor pair. Do you understand? So the crosses are pairs that do not include the dollar. That's a pair like Euro JPY. They do not include the dollar. Those are crosses of major and then another country. Then the exotic pairs involve a major currency and a currency from a developing or smaller economy. So currency pair like USD ZAR, USD ZAR. That's US dollar, and then South Africa. South Africa is considered a developing economy. Those are the three classifications. If you want to really understand it, you can go to Baby Pips or go to other sites that provide information about currency classifications and read more about it if you really want to understand the currency pairs, how they form, the reason why they named it USD. The note is short because if I want to include all that information, you are going to do like 3, 4, or 5 hours. You get it? How to trade Forex. While there are several ways to participate, we focus on a common derivative product. Forex CFD, there's sports FX, there's spread betting, there's retail, there's there are many ways you can trade the Forex market, but I selected this because this is what we are going to stick to. One thing that helps you gain understanding of something is streamlining your focus down to that single thing. You focus mainly on that thing to excel in it. So I wrote over here only Forex CFD. Now, you forget about the derivative tracking for now. Forex CFD is a contract for difference it's a contract for difference. What that means is that you are purchasing a contract for the difference in the price of the asset you are trading. Did you get that? Let me say it again. You are purchasing a contract for difference in the price of the asset you are trading. So contract for difference, yeah, let's say Bitcoin is at $100 and then it goes to $1,000. The difference in the price is what you are going to is what is termed age. I just put my hand on live camera. Anyway, Charlie, I'm sure it's not that serious to end the whole session and start again for share. Let's move on. Why? I'm posting it on YouTube until then. I'll just be more cautious next time. So, what was I saying? CFD. So when you end that difference in the price from 100 to 1,000, that's what we call CFD. You understand? You've purchased a contract for that, and when it hits the 1,000 and that's your target, you get your whatever money you're supposed to get on that trade. Do you understand? That's the contract for difference. The difference from 100 to 1,000. So contract for difference is a financial derivative used to speculate on price movements without owning the underlying asset. This is the difference. If you are buying crypto, you are buying Bitcoin, you are buying to own it. You understand? If you go to the gold market, I mean the live gold market, you are buying the gold to own it. You understand? But here you don't own the asset. Are just using it to speculate. So that's the contract for difference. And then CFDs track the market price. What that means is this is a derivative data we are looking at. The derivative data is derived from the asset itself. It's as the name suggests, derivative is derived from, let's say we are speculating gold to trade, is derived from the gold price. Do you understand? The actual gold data. That's what you are looking at is derived from. So the charts that you are looking at is just a derivative tracking of the actual price of the asset you are trading. So gold goes from 2,000 to 4,000, and then you are looking at it on the chart. It's all a derivative of what's actually going on behind the scenes. Because if they come in and they're putting plenty numbers on the screen, it might be very confusing. So CFDs track the market price, allowing traders to speculate on whether the price will rise or fall. Other participation methods include retail FX, spot FX, currency options, and currency exchange traded funds. Currencies are quoted in pairs. I mentioned that earlier. So USD JPY, GBP USD, Euro USD, Euro JPY, USD CAD, USD AUD, USD CHF. They are all currency pairs, and they are quoted in pairs. They are all, lack vocabulary. I have to work on that. They are all, yes, currency pairs, but the main point is they are quoted in pairs. You don't just see USD, you see USD paired with something else. You see, please leave. Yes, you get it. They are quoted with something else. They are quoted with something else. Every FX transaction involves simultaneously buying one currency and selling another. I explained earlier. If you buy a currency like USD right? You are buying USD while selling. You are buying USD while selling JPY. You are simultaneously, but although it doesn't record in the transaction that you sold USD is written over there that USD buy. But what actually happens behind the scenes is that you are selling JPY and buying USD. So it's a simultaneous transaction. Immediately you click buy USD Immediately you click buy USD Note, the transaction is always on the base currency. So immediately you click buy USD what you are doing is you are buying USD. But what's going on behind the scene is you are selling JPY. Do you get it? And I'll explain a lot further in the next video. That's the part 2. Because someone will ask, so you don't have JPY, how come you are saying you are selling JPY? You don't have USD, how come you are saying you are buying USD? You get it? It's very confusing, but I'll make sure it's not confusing for you. Base and quote currencies. Base currency is on the right, quote currency is on the left. The person who designed my note interchanged this. The base currency is on the right, the quote currency is on the left. Please, I'll edit this before I put the note in the group. So when you are watching and you get here, note it, please. The base currency is the first listed currency, example GBP in GBP USD. You see, it is the reference element and always has a value of 1. The quote currency is the second listed currency, also called the counter currency, example USD in GBP USD. If GBP USD is 1.2500, it means 1 GBP equals 1.2500 USD. All this explain what I was saying earlier. Key trading concepts: bid, price, ask price, and spread. The bid is the price at which a broker is willing to buy the base currency from you. The ask is the price at which a broker is willing to sell the base currency to you. The spread is the difference between the bid and ask prices, representing the cost of the trade. So the bid price is the price your broker is willing to buy the base currency from you. An example is you see the price of CD to dollar, and then you see that one dollar is to 12 CDs, 12 point something, but let's stick to 12 CD for simple, to make it simple, right? $1 equals 12 CD, right? But your broker might tell you they will buy it from you at 10 CD. Do you understand? That's the bid price. That's the price at which the broker is willing to buy the currency from you. You understand? So if you have a $1 and you want to change it to Ghana cedis, and then it's 12 cedis, but the broker is telling you they're buying it at 10 cedis. You get it? That's their bid price. And then the ask price is the price at which a broker is willing to sell the base currency to you. So if you are going to buy CDs, if you are going to buy CD with $1, right? You go to the Forex Bureau, you go to Yeah, let's use the forex bureau. You go to the forex bureau and give them the dollar, and then CD is valued at 12 CDs. What they can do is they can tell you, okay, we are going to buy from you at 11 CDs. You understand? These rates or these small coins that they've cut from the actual prices, they are spread. Do you understand? The spread is the difference between the bid and ask prices. That's the cost of the trade. So the broker is not just doing transactions for you because he likes you. He's not doing. He's there for a survival. He has to chop. You understand? So the spread, the small money they are removing or they are deducting from the transactions. Yeah, the small costs that they are removing from the transactions you are doing, or the money they are deducting from the transactions you are doing, is their chop money. Let's limit it to that. No, let me not use chop money for the for those who watch later. I mean the next generations. It's not chop money. That's what they take as a fee for the service they are providing. Thank you. Then the last slide says, are you ready to trade? Start speculating. The first step is to determine whether you want to buy or sell the base currency based on your market outlook. So this slide is just to, sum up what everything we've done in this slide. After knowing all this, let me not say this. After knowing this, right, it gives you a platform of knowledge to know how to start speculating. You can make money through Forex CFD, retail, spread bet, and all these things. You understand? So, are you ready to trade? You want to start speculating with me on the markets? You want to analyze economic indicators, choose your currency pair, determine your position, manage risk effectively? Then welcome to the team. Okay, it has been Desmond, and then that's all for today's session. Thank you for your time, and we were able to catch up for Friday's lost time. Thank you very much, and then I'll meet you guys later. Thanks for watching. I'll meet you guys later in the part 2. I'll make sure I make a part 2 of this session because it will include deeper things when it comes to the introduction of Forex trading itself. So thank you for your time, and then we'll meet later.